Another common valuation methodology used by investment bankers is precedent transactions. In this video, I'm going to show you exactly what is precedent transactions and how to answer questions around this to ace your interviews. Precedent transactions analysis is another relative valuation methodology, just like comparables analysis. The goal of precedent transactions analysis is to value a company by comparing it to what similar companies have been bought out in an M&A transaction. Another way to think about this is using the real estate example. So if the house to your left and the house to your right, which are pretty much the same as your house, if they have both been sold for $500,000 each, then it's relatively safe to say that the value of your house, because it's very similar, it's also going to be valued at $500,000. And that's pretty much it. We can pretty much do this in 5 steps. Step number 1 is selecting our precedent transaction comps. So this is where we have to select very similar transactions which have taken place to our company which we're trying to value. And some of the criteria which we have to observe is size, geography, industry, and time. Time is very important because when we're trying to find similar transactions, we can't look at transactions which occurred 10 years ago, 20 years ago, because market dynamics have changed. We have to look at transactions which have occurred 3 to 5 years ago at most. And the way we would find this is by a blend of looking at equity research reports, which will usually give us an indication as to these transactions, as well as using databases. Now, when you work at an investment bank, you will have access to Capital IQ, Mergerstat, and Thomson Reuters. Those are great places to find precedent transaction comps. And ideally, you want to have between 6 to 10 transactions in order to get a good idea as to how to value your company. Step 2 and step 3 we can pretty much combine, which is spreading and normalizing the precedent transactions. So here, you're pretty much going to be inputting financial data into your Excel template. And some of these data is going to be the share price pre-announcement of the acquisition and post-announcement. You're also going to need figures on the income statement, the balance sheet, and some key cash flow statement figures, as well as the share count and the option count and option details. The issue here is obtaining this information can be difficult depending on the company which you're dealing with. If you're dealing with public companies, so if a public company purchased another public company, then this information is going to be publicly available. However, if it's going to be a private company buying another private company, then they don't have to disclose this information. So it can be pretty difficult to get this information. And this can be problematic because a lot of great examples for public comps that you can use to value your company are in the private market, where we don't have any visibility or any numbers for. And in that case, we're not going to be able to use it. We can only use numbers that we do have. Step number 4 is calculating our multiples. Now, much like the public company comparables, we need to figure out the EV to EBITDA, EV to EBIT, price to book value. We have to figure out the multiples which we're going to use in order to value our company. We also need to make industry-specific multiples as well. And how we're going to build these multiples is by using the numbers which we inserted into our Excel file in step 2 and 3. The second part, we also need to figure out the premium paid. Now, when you're trying to buy out all of the shareholders in a company, effectively when you're trying to acquire 100% of the equity of a company, you have to buy out all the shareholders. Now, you can't just buy them out at the current share price. You have to sweeten the deal by giving them an extra amount. And this is known as the control premium. Usually, control premium range from 20 to 40% depending on the industry. So you have to do some analysis on what the average amount of control premium is for your industry, the company which you're valuing. And you have to add that to the purchase price. Step 5. The final step in the precedent transactions analysis is to analyze the multiples which we have. So you're going to have to look for anomalies, identify and research why they are anomalies. But if you have a pretty good set of precedent transaction comps, you can pretty much just find the mean or the average and use that and apply that to your company. So if the average EV to EBITDA that you figured out from your set of precedent transaction is 8, then you can pretty much multiply your EBITDA by 8 in order to figure out the enterprise value. And that's pretty much how you would go through a precedent transactions analysis in investment banking. Now again, if you would like to see a live demonstration of a precedent transaction and step by step, as well as being able to follow along in Excel, then you might want to consider signing up to our investment banking training program for students and graduates, where we go through financial modeling for investment banking, as well as go through investment banking interview questions and answers. With precedent transactions, there are some additional issues facing this type of valuation methodology. And you have to keep this in mind whilst you're building your evaluation. Issue number 1 is market condition. The issue with selecting transactions which took place at a distant past, say 10 years ago, 20 years ago, is the fact that market dynamics changes over time. So for example, in the year 2000, we had a dot-com bubble. So tech companies which were listed back then were trading at a really high multiple, and they were also purchased at a really high multiple. So if we were to use those transactions as a relative value for our company, this would artificially inflate our value. Issue number 2, transaction rationale. There is a difference when a strategic buyer, so when a company buys another company, versus when a private equity firm buys a company. Typically, when a company buys another company, they will purchase this company with a premium. So this will increase the purchase price. However, when you're looking at a financial buyer, at a private equity buying a company, they will reduce the amount of premium that they pay. So this will reduce the price. So you also have to take this into account when you're analyzing and looking at which transaction to choose, whether this deal was financed via a strategic buyer or by a financial buyer, because this will determine the level of premium paid. Issue number 3, deal dynamics. When we're analyzing precedent transactions, we also have to look at the context behind some of the deals. Was the deal taking place with a bidding war? Now, when there are multiple buyers interested in a deal, they will increase the price in order to outbid each other. Or was it a hostile takeover, in which case the deal or the bid had to be increasing over time in order to satisfy some of the last remaining shareholders? Or were there any other issues in the deal which could have affected the price? You also have to look at why certain prices were paid. And again, there are a lot of follow-up questions on this. For those of you with the investment banking interview guide, you can pretty much just open up the guide and look at all of the answers for this. And as usual, if you have any questions on this topic and on investment banking recruitment, then please put it in the comment section below. I'll try to answer it there. If I don't, then I'll probably answer it in our next Q&A session. So subscribe and click on the bell notification button to get notified when we release that video.